Is the Canadian dream dead? You've seen the headlines: skyrocketing house prices, rising debt, the insane cost of living, and families wondering if hard work still pays off.
Can I just move in with you? What's it like in Canada? Cold and expensive.
Do you think that 100K as a salary is enough to live in Canada?
No. Vancouver for sure, 250 if you want to live.
Why is life in Canada getting damned expensive?
But I wanted to know, has it really gone as bad as we think? So I did what I do best on this channel, and I dove deep into the hard data, and what I uncovered was pretty surprising. I'm going to walk you through the 1980s, 90s, 2000s, 2010s, all the way up to today in 2025, and I'll uncover where we're at today compared to the past and what it means for you and your family's future. Let's start with the 1980s. The 1980s had a rough start as well. Picture this, it's 1985. Canada was finally back on its feet again after the nastiest economic hangover since the Great Depression. Just a few years earlier, the recession had slammed the brakes on the economy. Unemployment spiked and mortgage rates soared past 20% per year. And buying a house felt like a gamble a lot of families couldn't afford. But by the mid-decade, the clouds were parting, inflation cooled, borrowing costs eased, and optimism slowly returned. Brian Mulroney was our prime minister, and he promised free trade and a fresh start. And on TV, the Cold War was everywhere. But hockey brought Canadians back to what really mattered. In Edmonton, Wayne Gretzky and the Oilers were unstoppable, lifting the Stanley Cup and reminding everyone that we knew how to win. But what about your income at this decade? Am I making more money? Well, in 1985, the average Canadian worker earned about $417 per week, which was roughly $21,700 a year back then. In today's dollar, that's about $56,800. Now let's look at my home. Can you afford one? Well, the average house back then cost an estimated $102,000 in 1984, which is about $268,000 in today's dollars. That worked out to a price to income ratio of about 4 years to 1, which means that your income of about 4 years will be enough to buy a house. Now, it wasn't easy though. Mortgage rates were still very high at 1985, hovering around 12 to 13%, down from the record highs of over 20% just a few years earlier. Now, monthly payments could eat up nearly half a household's take-home pay if you bought at the peak of that really high mortgage rates. But even so, by the mid-80s, rates were finally drifting lower and home ownership felt within reach again for many middle-class families. Let's look at shared prosperity. Are we all benefiting equally? Well, at this point in the 1980s, the top 1% took home about 7% of all the income. To me, that doesn't show a lot of wealth inequality. So in the 1980s, 2 paychecks comfortably covered the bills, left room for a few luxuries, and gave families real confidence in the future, and housing was very affordable. This was the decade my parents came to Canada, and they believed that if you worked hard, your kids would have every chance to climb higher. So let's look at the 1990s now. By the mid-90s, Canada was crawling out of another recession that had left factories quiet and paychecks uncertain. NAFTA was redrawing the map of work, sending jobs south and leaving some towns wondering what came next. In Ottawa, the deficit was the villain everyone talked about, and budget cuts were the norm. At home, life was changing fast. Personal computers were popping up in living rooms, and the annoying sound of dial-up internet was starting to connect families to the World Wide Web. Now let's take a look at your income in the 1990s. Are you making more money? Well, in 1995, the average income in Canada was about $24,000, which would be close to $51,000 today after adjusting for inflation. Then for your home, can you afford one? Well, the average single detached home cost $234,000 back in 1995, or roughly about $439,000 in today's dollars. So one salary meant a 9-year to 1 price to income house purchase ratio, meaning that it took 9 years of your income to purchase a house. And that already is seeing a huge increase from the previous decade, but it kind of balances out a little bit in this decade because interest rates were just so much lower than in the 80s. So even though the cost of a house went up by quite a lot in the 90s, it still was very affordable. Now let's look at shared prosperity. In 1995, the top 1% pulled a little bit farther ahead, and it claimed 8.4% of total income, which still isn't too bad in terms of wealth inequality. So for this decade, the dinner table stayed full, but 2 paychecks seem to now become more and more common and essential. Families could still get ahead, but it took tighter budgets, longer hours, and more hope that the kids would keep climbing. And if tax savings are on your mind, check out our free guide on 7 powerful income splitting strategies to legally reduce your tax bill. You can grab a copy on our website, the link is in the description. Now let's take a look at the 2000s. The early 2000s began with the sense that anything was possible. The dot-com crash had rattled investors, but the economy in Canada especially found its footing again. Alberta boomed as oil money poured in, and new suburbs sprawled out along highways across the country. But underneath the optimism, there was an edge of uncertainty. The shock of 9/11 lingered in the background, and it's a reminder that the world had become less predictable. Even so, I remember at this time, real estate felt unstoppable. For a while, it seemed like everyone knew someone who had flipped a house or was planning to. Then, almost overnight, it all turned. The financial crisis hit hard, companies closed, people lost jobs. Ottawa had to scramble to steady things, and they rolled out a lot of programs to keep the economy afloat. Luckily, it didn't hit us as bad as it did in the US though. But let's take a look at your income. Are you making more money in this decade? Well, by 2005, the average worker earned about $38,500 a year, which is equivalent to roughly $59,300 in today's dollars. As for your home, the price of an average single detached home in 2005 was about $323,728, which works out to just under $500,000 in today's money. This makes the price to income ratio though around 8-1, which is actually a drop from the previous decade, which means it's even more affordable in the 2000s than it was in the 1990s. As for shared prosperity, the top 1% of income earners here earned almost 12% of the total income, or 11.5% in 2005. But this was just before the financial crisis briefly dented their gains. And even after the recession though, the share remained quite high compared to previous decades, but still not totally unreasonable, like in the US. The bottom line is the economy was still growing and the headlines looked good, but for many families, it felt like life was a treadmill, working harder just to stay even and wondering if the next generation would ever pull ahead. Now let's talk about the 2010s. And this is when the math stops working. By the mid-2010s, Canada looked like a success story on paper. The economy had bounced back from the financial crisis, interest rates were at record lows, and tech was booming, oil was still pretty strong, smartphones were glued to every hand, and everybody seemed convinced that housing was the surest path to wealth. But just beneath the headlines, cracks were spreading. Wages barely budged while everyday costs kept climbing and home prices shot past what most paychecks could keep up with. And for many families, it was a decade where you did everything right and the math still didn't add up. So let's take a look at the income at this time period. So in 2015, the average Canadian worker earned about $954 a week, or roughly $49,600 a year. And after adjusting for inflation, that's close to $64,000 today. As for your home, this was the decade that the housing crisis came fully into fruition. Now, by 2015, the average single detached home cost $693,587 in Canada. And measured by your price to income ratio, the picture is stark. Now, in 2015, buying a home meant spending almost 14 times the average annual salary. And in some places in Vancouver, that might be even 25 times at this point. As for 2015, the top 1% captured actually less than it did in 2005, so it only had 11.3% versus 11.5% a decade earlier. So that means inequality of wealth in Canada has somewhat stopped growing at this point. But as I mentioned, this is the decade where housing costs became a runaway train and wages just couldn't keep up. But that's why financial planning matters more than ever. And at Blueprint, that's exactly what we help Canadians figure out. Whether you're deciding if it's the right time to purchase a house or to wait a little bit, or you just want a second opinion on your investments, our team has your back. So if you'd like to explore your options, check out our websites to see our services. Now let's look at the 2020s. By the mid-2020s, Canada looked prosperous at a glance. The country had come through the pandemic, unemployment was low, and stock markets kept breaking records. But for most families, the picture up close isn't so bright. COVID-19 had pushed everyday costs higher, and the return of inflation turned groceries, rent, and gas into constant worries. Wages ticked up on paper, but housing prices sprinted even faster, putting the dreams of ownership out of reach for millions. For many, the old promise that hard work would buy security started to feel less like a plan and more like a memory. Let's take a look at current income stats. Are you making more money at this point? As of April 2025, the average Canadian worker earns $1,297 a week, or roughly $67,000 per year. Note that the average is very different than the median, which I go over in a lot of other videos of mine. So the median income will actually be significantly less than this. Now let's take a look at home prices in 2025. The current average single detached home price in Canada is just over $1 million as of May 2025. So for a single earner, That's a staggering 15-to-1 price to income ratio, meaning it'll take you 15 years to afford the average house in Canada. And in cities like Vancouver and Toronto, it could reach upwards of 30 years. So it's much, much worse. And for many Canadians, especially younger Canadians or lower income Canadians, the dream of owning a home, especially a single detached home, has all but died. Condos might be affordable in some areas. It's really sad to see because that's always been the Canadian dream, is the white picket fence home. But for shared prosperity, recent years have brought new pressures. The pandemic disrupted many sectors, but high earners recovered quickly. And by 2022, the top 1% still held around 10% of all the income, which is actually a drop, which shows that there is more wealth equality in Canada than maybe even in the past 2 decades. Now let's take a look at all the numbers of the decades that we just went through, and note that these are all in nominal dollars, which are the dollar amounts at the time. So the housing, I really wanted to show the nominal cost because it really shows the price to income ratio, how it increased from 4-to-1 in 1980 to 15-to-1 today, which is insane. So some interesting trends I spotted here. So for affordability, in the 1980s, a single income could easily still buy a house without feeling out of reach. And by the 1990s, though, prices have more than doubled and a gap between earnings and housing costs become harder to ignore. Then the 2000s brought some relief as incomes rose faster, but it didn't last too long because in the 2010s, housing costs exploded yet again, outpacing incomes by a wide margin. And now today, even with 2 good salary earners, it could barely cover the cost of owning an average home in Canada. As for income growth, even though the nominal incomes climbed each decade, and today in 2025, it actually is higher than it was in the past in terms of real actual today dollars, but it's not even close to the rise in the cost of living as well as housing. But there is some good news. As for inequality, the share of income going to the top 1% rose from 7% in the 1990s to 12% in the 2000s, but it's dropped down again, so inequality hasn't been that bad. And while the top 1% did see their share of income rise, Canada's story has been less about the ultra wealthy taking everything and much more about housing driving the divide. We've very much become a nation split between homeowners and renters. And if you were lucky enough to buy a house at an affordable price, you're likely way ahead today of any renter, while everyone else is struggling to keep up. But I want to end on a more positive note. Every decade has its challenges. There was sky-high interest rates in the 80s, factory closures in the 90s. There was also the financial crisis in the 2000s, and wage stagnation and the start of the pandemic in the 2010s. Yet Canadians adapted, persevered, and kept moving forward. And my hope is that if housing costs can be brought under control eventually, there's every reason to believe that the next generation will still have a clearer path to prosperity again. So I don't think the Canadian dream is dead, it's just evolving. And here's the good news, your financial future isn't set in stone. With the right planning, fresh strategies, and a willingness to look beyond traditional milestones, you could still build security and wealth even if it looks different than it did for past generations. And I've seen it with our clients here at Blueprint. This story matters because it shows how quickly the dream might slip away, even when you're doing everything right. So if you're wondering how to build stability at a time like this, that's exactly what we help people do here at Blueprint Financial. So you can head to our website to explore your options, grab your free guide, and book a chat. And if you found this helpful, hit subscribe and like the video. You don't want to miss what's next. And YouTube's picked out another video it thinks you'll love, so go ahead and check it out here.